Money is a nation's silent ambassador. Its strength whispers the story of its discipline, stability, and trust. When the world thinks of power, it imagines armies, skyscrapers, and natural resources. But sometimes the truest power is silent, printed on polymer notes and coded in electronic transfers. Singapore's currency, the Singapore dollar, is one of those quiet powers. It rarely makes headlines, yet traders, corporations, and governments all over the world respect it. How did a small island without oil, farmland, or a vast population craft one of the world's strongest currencies? Today on the Asian Scrolls, we unfold the answer chapter by chapter. In this episode, we open a scroll that glows with numbers and policy rather than myth and legend. We're diving deep into the anatomy of a strong currency, the invisible architecture that makes one nation's money a safe harbor while others drift. Singapore is not just an economic success story. It is a masterclass in monetary engineering. Born as a tiny trading port with no natural resources, it built a currency so respected that investors treat it like a fortress in a storm. By the end of this video, you'll see why the Singapore dollar has become a symbol of discipline, foresight, and quiet strength, and why the world takes it seriously. Chapter 1. A currency managed like no other. Most countries treat their central bank like a thermostat. Turn the dial up with higher interest rates to cool an overheating economy. Turn it down to warm up spending. It's a simple, familiar lever, the interest rate, and almost everyone uses it. But in the early 1980s, Singapore's policymakers realized something profound. What works for a large, diversified economy could be dangerous for a tiny, trade-dependent island. Here, almost every product on the shelf is imported. Almost every business depends on global shipping lanes. Price shocks come from abroad, not from inside. That means that tinkering with local interest rates wouldn't shield Singapore from imported inflation or currency swings. It would simply add another layer of instability. So, the Monetary Authority of Singapore, MAS, rewrote the rulebook. Instead of steering the economy by the short-term interest rate, MAS decided to anchor it by the exchange rate, the price of the Singapore dollar against the rest of the world. This was radical at the time. Few nations dared to do it because it requires constant vigilance and immense credibility. But MAS built exactly that. It created a system with three quiet but powerful features: a confidential basket of currencies. The Singapore dollar isn't pegged to one single currency like the US dollar. Instead, MAS tracks a secret mix: dollars, euros, yen, yuan, and others weighted to reflect Singapore's trading partners. This basket smooths out shocks from any single country. A managed band. The dollar is allowed to float only inside a preset corridor. It's not a fixed peg, but it's not a free-for-all either. The band acts like soft guardrails on a highway, letting the car move but keeping it from veering off a cliff. Regular, gentle adjustments. Every few months, MAS reviews the band. If inflation is creeping up, it tilts the band upward to let the currency appreciate slowly. If growth needs support, it can flatten the slope or widen the band. These are subtle, predictable moves, not sudden shocks that jolt markets. Think of a ship navigating a crowded harbor. Instead of wrenching the wheel back and forth, the captain makes small, deliberate turns to keep a steady course. That is MAS's philosophy with the Singapore dollar. For businesses and investors, this approach is priceless. Exporters know roughly what they'll earn months ahead. Importers can sign contracts without fearing a currency plunge. International investors see a predictable environment rather than a casino. In finance, predictability is gold. It lowers risk, lowers borrowing costs, and attracts long-term capital instead of speculative hot money. By the time other nations noticed, Singapore had already built decades of credibility. Its dollar became known not just as another Asian currency, but as a signal of discipline and stability, a rare anchor in a region of volatility. Chapter 2. The Shield of Foreign Reserves. A bold monetary policy is only as strong as the resources behind it. A small nation can announce any rule it likes, but unless it has the firepower to back that rule, the markets will test it and often break it. Singapore's leaders understood this from day one. So, quietly and patiently, they built one of the largest foreign exchange reserves per capita in the entire world, more than US, 400 billion today. For a country of just 5.6 million people, that's extraordinary. But these reserves are not just a trophy number on a government spreadsheet. They are a living shield, an emergency force that can be deployed at a moment's notice to defend the Singapore dollar. Here's how it works. If speculators try to short the currency, MAS can instantly sell billions of foreign currency and buy back Singapore dollars, creating demand and pushing the exchange rate back into its desired band. If the opposite happens, a flood of money pouring in drives the dollar up too high, MAS can absorb excess inflows by buying foreign assets, preventing harmful overappreciation that would hurt exporters. This back-and-forth action is like a grandmaster playing chess several moves ahead. Because the reserves are so deep, the market knows MAS can keep doing this for a long time without running out of ammunition. That knowledge alone deters many attacks before they even begin. Think of it as a castle in a turbulent landscape. The Singapore dollar is the keep, MAS is the garrison, and the foreign exchange reserves are the moat and drawbridge combined. They don't just block invaders, they show the world the castle is well defended. This credibility becomes self-reinforcing. When global investors see a currency with a massive war chest behind it, they are more likely to buy it, not sell it. When traders know a central bank can defend its band, they stop trying to break it. This is why, in crisis after crisis, from the Asian financial crisis of 1997 to the global financial crisis of 2008, the Singapore dollar has remained remarkably stable, while other regional currencies swung violently. The reserves are not simply cash sitting idle. Much of it is actively managed and invested by agencies like GIC and Temasek, generating returns for the nation while remaining available for emergencies. It's both a shield and a storehouse, a dynamic, disciplined mechanism designed to give Singapore options when others have none. In the world of currencies, perception is power, and with its colossal reserves, Singapore projects the image and reality of a country whose money cannot easily be bullied. Chapter 3. Fiscal Discipline and Sovereign Wealth. In much of the world, government budgets resemble credit cards maxed to the limit. Deficits pile up, interest payments balloon, and debt becomes a permanent companion passed from one generation to the next. The result? Currencies weakened by doubt, investors demanding higher yields, and nations losing room to maneuver when crisis strikes. Singapore made a radically different choice. From its earliest years of independence, the state was built on the belief that a nation must live within its means. Taxes collected in good times were not spent recklessly but saved, invested, and carefully deployed. Deficits were seen not as a tool but as a last resort. Borrowing from foreign markets was avoided unless absolutely necessary. This discipline became a cultural reflex inside the civil service. The consequence of this philosophy is striking. Singapore routinely runs budget surpluses. It has no net external debt, and it treats every Singapore dollar as a custodian, not a consumer. But saving alone is not enough. The leaders of Singapore realized early on that idle cash loses value, so they transformed surpluses into a living engine of national wealth by creating two global investment powerhouses. Temasek Holdings, established in 1974, Temasek began by holding stakes in Singapore's own companies. Over time, it grew into a global investor, owning airlines, banks, ports, telecoms, biotech firms, and tech giants across Asia, Europe, and the Americas. GIC, Government of Singapore Investment Corporation. Founded in 1981, GIC manages the country's foreign reserves for the long term. It invests quietly but widely in equities, bonds, real estate, infrastructure, private equity across more than 40 countries. Together, these sovereign wealth funds now manage well over $1 trillion. Their portfolios span every continent. Their profits are not bonuses for a few, but a safety net for all Singaporeans, a cushion for future generations, and a shield for the currency. This arrangement sends a powerful signal to the markets. Singapore does not finance its spending by printing money. It does not rely on fickle foreign creditors. It builds assets instead of piling up liabilities. Every Singapore dollar in circulation carries that reputation. It is backed not only by policy, but by ownership, a piece of global companies, ports, data centers, airports, and banks, sitting quietly in Temasek and GIC's ledgers. For investors, this creates trust. For citizens, it creates resilience. And for the Singapore dollar, it creates an aura of solidity rare among currencies. A small nation with a balance sheet bigger than many large ones, signaling to the world that prudence, not excess, is its default. Chapter 4. Trade surplus and high-value exports. Singapore is a speck on the map barely 50 kilometers from east to west, but its trade arteries pulse like those of a continent. Every day, in the shadow of its skyline, one of the world's busiest container ports loads and unloads ships from every ocean. Tankers, freighters, and mega-carriers pass through like blood cells through a beating heart. But the scale alone is not what makes Singapore's trade unique. It is the quality of what flows through these channels. From its earliest days, Singapore refused to rely on low-value, easily replaceable commodities. Instead, it became a refiner, assembler, and high-tech service hub. Today, its exports include electronics, semiconductors, precision components, and high-end consumer technology that power devices across the globe. Petrochemicals, refined fuels, industrial chemicals, and specialty materials produced in one of the world's largest integrated refining complexes. Pharmaceuticals and biotech, vaccines, active ingredients, and cutting-edge medical products manufactured to exacting standards. Financial services, from wealth management to insurance to complex derivatives, invisible exports that generate steady fees in global currencies. These are not bulk raw materials with volatile prices. They are specialized, high-value goods and services that command premium margins and long-term contracts. That makes Singapore's export earnings far more stable than those of a commodity-based economy. And the effect on the currency is direct. When overseas buyers want Singapore's products or services, they cannot pay in their own currencies. They must first buy Singapore dollars. Every shipment, every service contract, every insurance policy means another transaction in SGD. That creates a permanent organic demand for the currency. Because exports consistently exceed imports, there is a persistent inflow of foreign exchange into Singapore's banking system. Those inflows strengthen the national balance sheet, enlarge reserves, and keep the Singapore dollar well supported without the need for artificial props. This is how a small nation exerts large monetary gravity. It is not a one-time boom but a continuous current, a high-trust, high-tech ecosystem that converts global demand into steady, recurring foreign exchange. In the quiet arithmetic of currency markets, that steadiness is power. Chapter 5. Political stability and rule of law. In finance, capital is like water. It flows downhill to the lowest risk. And risk is not only about numbers on a balance sheet, it's about trust. Trust that contracts will be honored, that courts will be impartial, that governments will not change the rules overnight. Singapore has spent decades cultivating exactly that kind of trust. It is regularly ranked among the least corrupt countries on earth. Its public servants are well paid to discourage bribery. Its anti-graft agencies are empowered, and its legal system is transparent and swift. Court cases are decided not by connections, but by precedent and evidence. Regulations are published clearly, applied consistently, and rarely rewritten on a whim. For global companies and investors, this is oxygen. When you set up your Asian headquarters in Singapore, you know that contracts will be enforced, taxes will be predictable, and the playing field will not tilt beneath you. That certainty allows firms to plan decades ahead, not just months. The effect on the currency is profound but quiet. Every time a multinational parks its treasury operations in Singapore, it creates demand for Singapore dollars. Every time a wealthy family chooses to manage its assets there, it shifts capital into Singapore's banking system. Each of these inflows is a vote of confidence in the Singapore dollar and the system behind it. This is why calling Singapore just a financial hub is too small. It is a reputation hub, a place where money rests because it trusts the ground beneath it. When you hold Singapore dollars, you're not only holding a claim on a central bank, you're holding a piece of a framework built on order, prudence, and credibility, a framework that investors across the globe have tested and found solid. In a volatile region, this is Singapore's quiet superpower. Stability is not an accident. It is policy, culture, and enforcement combined. And it gives the Singapore dollar something no chart can measure directly: moral weight. Chapter 6. The Financial Hub Effect. Step into Singapore's Marina Bay at sunrise, and you'll see glass towers catching the first light. Inside them, banks from every continent hum with activity. Traders monitor screens glowing with prices from New York, London, Tokyo. Lawyers draft contracts for billion-dollar deals. Compliance officers file regulatory reports in a dozen languages. It feels less like a city block and more like a nerve center for the global economy. Singapore is not just a regional banking center. It is a gateway for global capital into Asia. Funds raised in Europe to invest in Indonesia, Thailand, Vietnam, or China often pass through Singaporean banks. Corporations list on Singapore's exchange to tap international investors. Private equity firms base their teams here to scout opportunities across Southeast Asia. And wealthy families from around the world set up family offices to manage their fortunes in a stable jurisdiction. The numbers are staggering. Trillions of dollars are cleared, managed, and invested through Singapore's financial system every year. Hedge funds, sovereign wealth funds, insurers, asset managers, multinational corporations all route money through this tiny island. Each of those flows means accounts in Singaporean banks, settlements through its payment systems, and compliance with its regulators. And here's the quiet effect on the currency. Every transaction, every portfolio shift, every capital raise requires Singapore dollars or Singapore-based banking. That constant flow does two things at once. It strengthens the SGD by creating steady demand, and it deepens its liquidity, making it easier and cheaper to trade. A currency that is widely held and easily transacted becomes more attractive, which in turn attracts even more flows. It's a self-reinforcing loop. None of this is an accident. For decades, Singapore's government has made regulatory clarity, tax competitiveness, and infrastructure investment its calling cards. It built world-class payment and settlement systems, a stable legal framework, and an efficient dispute resolution environment. It trained a multilingual workforce of lawyers, bankers, and compliance specialists. It created a reputation for being tough on money laundering but friendly to legitimate business. In doing so, it made itself indispensable to global finance. This is the hub effect in action. Capital arrives because it knows other capital is already there. Services grow more sophisticated because demand is concentrated. And the Singapore dollar benefits quietly from the gravitational pull of a financial ecosystem built on predictability and trust. Chapter 7. Stability by design, not by chance. Now step back and look at the whole picture. An island nation with no natural resources, wedged between giants, once dismissed as a vulnerable trading post, and yet, today, its currency is among the most respected in the world. How? Not by fortune, not by windfall, but by design. Singapore chose a path that few others dared. It built an exchange rate-centered monetary policy when everyone else was tinkering with interest rates. It amassed massive foreign reserves as a shield long before crises struck. It ran fiscal surpluses and turned excess cash into sovereign wealth instead of debt. It nurtured a perpetual trade surplus by becoming indispensable in high-value global supply chains. It cemented political stability and world-class governance, making itself a haven for trust. And it created a financial ecosystem that channels global capital like water through an aqueduct, steady, controlled, and enriching. Each of these pieces is impressive on its own. Together, they form a fortress where every wall reinforces the next, where the moat is deep, the gates are strong, and the drawbridge is ready. It is a currency whose strength is not a mystery, but a mirror reflecting the nation's discipline. When you hold the Singapore dollar, you are not just holding paper with a lion crest. You are holding the product of decades of deliberate policy, restraint, and foresight. You are holding a promise that, in a volatile world, some places still believe in order, prudence, and reliability. This is not luck. This is not chance. This is Singapore, a city-state whose money tells the same story as its skyline. Stability built brick by brick, policy by policy, choice by choice. Every time a Singapore dollar changes hands, it whispers a story of discipline, of foresight, of quiet strength carefully built over decades. It is living proof that a small nation can wield global financial power not by size, but by stability. If this journey through Asia's financial powerhouse opened your eyes, don't keep it to yourself. Click like, tap subscribe, and share this episode of the Asian Scrolls so others can uncover the hidden gears behind the world's strongest currencies. And join the conversation below. Which Asian currency do you think could rise next? Your insight might just become the spark for our next episode.